Well, there's been a lot of talk lately about silver and gold stepping into one of those market moments that sounds impossible right up until it isn't. So, in this video, we're going to separate what actually matters from what's just loud, and you're going to walk away with a much clearer picture of why this move may be getting a lot more serious than people realize. Now, it is Monday, April 13th in New York, so go ahead and comment below what day and date you're watching from. And real quick, if you value the work I do here, support the channel by subscribing and commenting John A.G. Best. It helps more than you think. Now, the reason this story is getting dangerous isn't because of one headline. It's because several headlines that usually stay in separate boxes are suddenly piling on top of each other. You've got failed talks with Iran. You've got the United States moving toward a blockade of Iranian ports. You've got the U.S. military saying it has started setting conditions to clear mines in the Strait of Hormuz. And you've got crude jumping hard on the news, with tanker traffic turning cautious again. That's not a normal backdrop for precious metals. That's the kind of backdrop that changes behavior. Now, one quick correction here, because this matters. Some people are going to talk about this like the entire Strait of Hormuz has officially been shut down to everybody. That is not exactly what was announced. The blockade described by U.S. officials was focused on maritime traffic tied to Iranian ports, while vessels moving to non-Iranian ports were said not to be impeded. That doesn't make the situation calm. It just means the reality is messy, not cartoonish. And messy is more than enough to shake markets. And once energy gets shaky, metals don't just sit there politely and wait their turn. We already saw that in aluminum. Iranian strikes on major Gulf producers helped send aluminum to the highest level in about 4 years, and one of the biggest regional producers said its major site took significant damage. That tells you this is not only an oil story. This is a logistics story, a power story, a shipping story, and now an industrial metals story. So where does silver come in? This is where it gets interesting, because the possible trigger here is not the usual thing people obsess over. It's not a dramatic vault rumor. It's not just coin demand. It's not one flashy chart on social media. It's the possibility that China halts sulfuric acid exports starting in May, right when raw material bottlenecks tied to the Iran war are already squeezing the system. And that matters because the restriction would cover sulfuric acid produced as a byproduct of copper and zinc smelting. Now, sulfuric acid sounds boring. I get it. It sounds like one of those stories people scroll right past. But markets get blindsided by boring things all the time. Based on recently published commodity reporting, sulfuric acid prices had already exploded over the last couple of years, and Chinese smelters were leaning on that acid business more and more as their core economics got tighter. That means the chemical side of the supply chain was already under stress before this latest geopolitical flare-up even showed up. And here's the silver angle. Silver is not nearly as independent as most people think it is. According to the latest U.S. Geological Survey summary, silver is still primarily produced as a byproduct from lead, zinc, copper, and gold mining, with polymetallic deposits accounting for more than 2/3 of world silver resources. In plain English, a huge chunk of silver only comes out because somebody was really chasing something else. That means if copper operations get squeezed, silver doesn't get to vote. Silver just gets dragged along for the ride. And copper operations are not exactly coming into this moment from a position of strength. From recent market updates, one major Chilean producer saw February output fall by roughly 1/10 from a year earlier, while the world's biggest copper mine was down by the high single digits. At the same time, China's copper trade flows have been shifting hard, with imports weaker and exports stronger, which tells you the global copper picture is not as stable as people would like to believe. So now stack that together. If acid availability tightens, copper processing gets tougher. If copper supply stumbles, byproduct silver gets pinched. And if silver was already in deficit, you've now taken a market that was leaning forward and shoved it a little closer to the stairs. That last part matters. The silver market is expected to run a deficit again this year, which would make it about 6 straight annual deficits. The same outlook says the market is still leaning on above-ground bullion inventories, not some giant new wave of mine supply magically showing up out of nowhere. That is not the profile of a relaxed market. Now, I do want to challenge one popular talking point, because I think this is where people can get sloppy. You'll hear some folks say, industrial demand for silver is just a straight line higher and there's no substitute anywhere. That's too simple. The latest silver outlook says industrial fabrication is actually expected to soften this year, partly because the solar industry keeps finding ways to thrift silver or substitute away from it. Reuters also reported that solar manufacturers are accelerating that shift as silver costs stay high. So, no, not every demand lane is flooring the gas pedal at the same time. But here's why I still think the bigger picture stays constructive. That same silver outlook says data centers, artificial intelligence-linked technologies, and the automotive sector are still supporting silver use, while physical investment is expected to rebound sharply this year. So even if one industrial lane cools off a bit, the whole story doesn't suddenly collapse. It just becomes more selective, which is exactly what mature bull stories do. And there's another fresh point that people are not talking about enough. The latest U.S. Geological Survey summary notes that silver was added to the final U.S. critical minerals list for last year. That doesn't mean Washington suddenly turned into a silver stacker. But it does tell you the metal is being viewed less like a shiny side character and more like a strategic material. Once that happens, the conversation changes. The China angle changes too, by the way. A lot of people are speaking as if China has already slammed the door on silver exports specifically. The more careful read is that formal silver export restrictions have not yet emerged. In fact, shipments last year were reported at the highest level in a very long time. The concern is not that a silver export ban is already here. The concern is that China may choose to prioritize domestic consumption if strategic pressure keeps building. That's a very different claim, and it's the more responsible way to frame it. So this is not a story where I'm telling you everything has to break tomorrow morning. What I am telling you is that silver sits right in the middle of a nasty intersection. It touches industrial policy, it touches military tension, it touches shipping lanes, it touches electrification, it touches investor fear. And because so much of its supply is tied to other metals, it can get squeezed by problems that don't even start in the silver market. That is why gold matters here too. Gold doesn't need the same industrial setup to respond. Gold reacts when confidence cracks. Silver reacts when confidence cracks and supply gets weird at the same time. When both metals start catching bids for different reasons inside the same macro backdrop, that's when things can get a lot more explosive than people expect. And the US backdrop is not helping anyone relax. Consumer sentiment in early April dropped to the lowest reading on record. Not just low, not just disappointing, the worst reading ever in that survey. The same report said consumers were suddenly expecting hotter inflation ahead, and the comments in the survey pointed directly at the Iran conflict as a reason people felt worse about the economy. That is not a healthy psychological setup for a consumer-driven system. Then look at actual inflation. The March Consumer Price Report showed headline inflation running a little above 3% year over year, but the monthly shock came from energy. Gasoline posted one of the nastiest monthly jumps on record, and energy had its biggest monthly rise in decades. So even if someone wants to argue that the inflation story is contained, the real world doesn't feel contained when fuel punches everybody in the face at once. And this is where I think everyday life matters more than elegant theory. The Postal Service is now proposing another jump in mailing prices for July, including a 4-cent increase in the forever stamp into the low 80-cent range, or roughly a 5% move. That's not the whole inflation story, obviously, but it is a tiny, real, visible reminder that the cost structure underneath daily life keeps grinding higher. People notice that stuff. They may not quote an inflation index at dinner, but they notice the bill. If you're successful, share your success story in the comments so others can stay motivated. Now here's the part that makes the macro picture even more uncomfortable. The Federal Reserve has reportedly been asking major banks for details on their exposure to private credit after a rise in troubled loans and stronger redemption pressure in that industry. The estimate attached to that market is around $2 trillion. That does not automatically mean we're staring at another financial crisis. But when the central bank starts asking the big players how exposed they are, it usually means somebody in the building thinks the smoke detector is worth checking. And again, I want to stay fair here. The same reporting says the official line from policymakers is that stress still looks mostly contained to that corner of the market, so I'm not going to pretend this is already another mortgage meltdown. That would be lazy, but contained is one of those words that sounds comforting right up until it isn't. We've heard that movie before. So when you put all of this together, what do you get? You get geopolitical risk that can jam up energy and shipping. You get visible damage in industrial metals infrastructure. You get a possible acid restriction that could pressure copper processing. You get silver supply tied to byproduct mining rather than pure silver economics. You get another deficit year in silver. You get a nervous American consumer, sticky inflation pressure, and a central bank quietly looking under the hood of private credit. That's not one story. That's a pileup. And this is why I keep saying the metal story is bigger than one chart and bigger than one headline. We may be moving into a phase where metals are not just trading on jewelry demand, or one central bank headline, or one retail frenzy. They're being re-rated as strategic assets, industrial necessities, and confidence hedges all at the same time. Now, could some of this cool off? Of course it could. If the Iran situation de-escalates faster than expected, if acid restrictions get softened, if copper output stabilizes, if solar substitution bites harder than people think, then silver might not get that dramatic straight-up squeeze some folks dream about. That is absolutely possible. But even under that softer scenario, I don't think the big takeaway disappears. because the broader message is still the same. Supply chains are more fragile, strategic materials are more political, inflation confidence is shakier, and gold and silver are no longer being treated like old relics from another era. They are being pulled back into the center of the conversation. So my question for you is this. Do you think silver is the better opportunity from here, or do you think gold is the steadier play while this geopolitical mess keeps unfolding? And second question, do you think this turns into a short-term scare, or are we watching the early stage of a deeper metals repricing? Either way, I would not get distracted by every screaming headline, but I also would not dismiss this setup as just another passing panic. There are too many moving parts lining up in the same direction, and some of the most important ones are still being underestimated because they sound too technical or too boring to matter. Those are exactly the ones that tend to matter most. So stay sharp, keep your emotions under control, and keep your eye on the difference between noise and structure. Noise changes by the hour, structure changes by the year. And right now, the structure underneath precious metals looks a whole lot stronger than most people are willing to admit. All right, thank you for being here. Thank you for spending this time with me. And thank you to everybody supporting the channel. And as always, this is for education and discussion only. I'm sharing how I see the landscape, not telling you what to buy, sell, or bet the house on. Do your own homework, make your own decisions, and don't outsource your future to anybody on the internet.